Well, Verizon's an example of the credit activism that I was talking about earlier. Our data science team actually created three quant models which use artificial intelligence to determine the standalone credit profile of an individual entity. And they do that by using the S&P methodologies and the company's quantitative metrics. And they rate every single bond in the world which is rated by S&P. So an entity's credit rating, won't always equal its quantitative rating, because rating analysts have discretion to either notch up or down based on qualitative adjustments that they may be concerned about. So the job of the credit research team then is to understand what are the motivations for those qualitative adjustments by the rating agencies. So with Verizon, our data science team advised in an investment meeting that the BBB+ rating for Verizon could actually be single A-, based solely on the entity's credit metrics. So that's when the credit research team became involved, and we did some heavy DD to understand what were the rating analysts' requirements for upgrade, and there were three which became four based on the company's credit metrics. And we determined that they were very, very negative on all of these requirements. Now, it took 9 months for our models, our earnings models, to prove correct. And Verizon had actually achieved 3 of those 4 metrics, which were required for an upgrade. And the fourth metric was a leverage target, which was 2.5 times. Now, every single analyst in the street had Verizon meeting that target, but over different timeframes. So we were very frustrated. This was more than enough for Verizon to be upgraded from BBB+ to a positive outlook. So we rang the analyst in New York repeatedly to understand what his hesitations were. And what we discovered was that he also agreed that they were heading in the right direction towards achieving the leverage target, the fourth target. However, he was concerned that they wouldn't maintain their leverage there once it was achieved. And this was all well documented within his credit reports. So we rang the assistant treasurer at Verizon, and we gave him our impression of what S&P's hesitations were. And during the conversation, we asked him, look, have you ever considered releasing a formal leverage target? You've said to the market you want to maintain leverage below this level, but have you considered a formal target? Now, this is the assistant treasurer of, at the time, was the second biggest corporate bond issuer in the world, so he's very, very professional. He said, thank you very much for your interest in the company. We speak to S&P often, and we're well aware of their concerns, thank you. So anyway, by the end of that month, Verizon had announced a formal leverage target, which was a range, which was set at a lower level than S&P's requirements. And a month and a half later, S&P upgraded the outlook to positive. And with words to the effect, the instigation of a formal leverage target provides clarity with respect to management's fiscal policy, financial policy. So that's just an example of, rather than sitting back and hoping, actually involving ourselves in this situation. Another example, which I mentioned earlier, is the Virgin bonds, which is a bond we avoided in 2019. Virgin management issued a $325 million bond to repurchase 35% of their Velocity Frequent Flyer program, which they had previously sold in times of difficulty to provide liquidity. Now, it wasn't just that the business was unprofitable and was leveraged and would struggle to withstand an external shock like a recession. We're also concerned about the quality of the loan documentation. Having worked in high yield, well aware of what is standard in such a bond issue, the level of protection provided from the events of default and the negative pledges just was not standard. It gave management the ability to continue to leverage the company even after the bond issue. And in March 2020, we actually took down borrow. We attempted to short the bonds, which were listed as trading in the 70s, but they simply weren't trading. There was no bid. Another example is with RMBS, registered mortgage-backed securities. Now, our data science team has developed some world-class models, which include models, hedonic models for measuring arrears. So at the beginning of 2020, we were concerned about a number of things, but two of the things were a reduction in demand from a reduction in the committed liquidity facility, the CLF, and we're also concerned about the level of arrears building up in the system with the COVID pandemic. and the regulatory treatment of those. And we were concerned about RMBS structures when that regulatory treatment ended, and the principal payments, which were flowing pro rata through these structures, would once again become sequential. And look, we were never suggesting that there was a terminal event for RMBS. And the banks have done very well in reducing the number of deferred home loans. But we were concerned that the asset class, with these headwinds, would struggle to outperform relative to, say, major bank senior or tier 2 or hybrids. So once again, rather than sit back and hope that the arrears profile would improve, we actually exited almost all of our RMBS exposures, which is over $500 million. It was $550 million worth. And this actually turned out to be vindicated by the relative performance of those other asset classes which we pivoted into.